Hello everyone, April Markland here at Comprehensive Planning, back in our series for Life Insurance Awareness Month. Today, I wanted to share with you a life insurance opportunity opened up by the passage of the Secure Act at the end of 2019. We did share this idea in the spring, but I thought it important to share it again. And Derek Archie has a great way of presenting this idea. So with that, I will give you to Derek.
Hi, this is Derek Archie. I am here to talk to you about an old strategy that's made new again by some recent legislation and changes in the law. As you may know, the Secure Act has passed, and what this means is that if you have a client who passes away with an IRA and leaves that IRA to a non-spouse beneficiary, that non-spouse beneficiary has to distribute those funds within 10 years. So the old strategy of stretching that IRA out and having tax deferral isn't going to work. The IRS wants to get its money. That money has to come out within 10 years and the client is going to have to pay taxes. So if you go back to the shelf and we dust off an idea, IRA maximization for those legacy IRAs, this is a way to use life insurance to leverage up and better pass that asset to the next generation. So if we think about it, if you have a client with an IRA that's not using it for income, that is a legacy asset, and they pass away, there's only three places that that asset can go, that money can go. It can go to your family, it can go to a charity, or it can go to the government. So let me walk you through some concepts and some ideas just to get you thinking about this. Let's take a client, a male who is 70 and a female who is 65. And let's say that they have a $500,000 IRA, and that $500,000 IRA is growing at 7%. Now, if they do nothing, that IRA is going to grow over time until they pass away. And we know that required minimum distributions will come out now starting at age 72. And we know that at some point we're going to have to pay those taxes. Now, when we pay those taxes, we're not entirely sure. So for the purpose of our discussion, we're going to look at how far that IRA grows and what the taxes are that are implied or embedded in that IRA. And what I mean by that is, as an IRA grows and you're taking out minimum distribution, you're still seeing that asset value go up. And at some point, the distributions are large enough that it is more than you're earning, and then the asset value goes down. So let's take that $500,000 IRA growing at 7%, and let's take the peak value of that IRA. And under our hypothetical example, that IRA ends up being worth, at its most, $740,000. And at that point, if we assume a 40% tax rate, we're talking about embedded taxes of $300,000. Now, if the client does nothing and passes away, that means that their heirs are going to receive $440,000. Charity, nothing goes to charity, a big goose egg. And the IRS, the government, they're going to get their $300,000. Now, how can we help this situation and leverage and get more to our beneficiaries? Well, one way is to use life insurance. So let's say that we took some money out of that IRA while they are alive and we bought a life insurance policy. We could take $5,000 a year out of this, which is far less than what the minimum distribution is going to be at age 72. We can take $5,000 a year and use that as a life insurance premium. That life insurance will be $300,000 to replace the taxes that we know we are going to lose. So using this strategy where we replace taxes, the $440,000 goes to the family, plus the $300,000 life insurance policy goes to the family, so they get $740,000, which is what the peak value of that IRA is. Now, in this example, charity still gets nothing, and the IRS still gets paid $300,000. However, what we've done is we've actually passed 68% more to the family. What if we wanted to take this to the fullest? What if we wanted to maximize what we can pass and really juice this thing up? Well, in our example, our hypothetical example, we're going to go all the way and we're going to use all the earnings in that $500,000 IRA. So if it's earning 7% a year, that means that's $35,000 a year of earnings in that IRA. Let's take what would be the after-tax amount of that out of the IRA, about $20,000, and let's buy the most life insurance that we possibly can. And I want to point out at this point, we're talking about this life insurance because we have a healthy male and female, and because the first spouse will pass the IRA to the second spouse. We're talking about second to die life insurance so that we get the most bang for the buck. So we're going to take $20,000 and we are going to buy a $1.2 million life insurance policy. Then we're going to leave that IRA to charity. And because we're using all the earnings, it hasn't grown, so we're leaving $500,000 to charity. And in this example, we have disinherited the government. They get nothing. Our total legacy is $1.7 million, and this represents $268,000 or 268% more than if we had done nothing. And obviously, in a situation like this, we don't have to go all the way. We don't have to be as aggressive as to take all the earnings. You can have all points in between. But this should give you an idea of thinking about, is there a better way, using the leverage of life insurance, to pass this legacy asset? If you have clients that this may help, please give me a call or send me an email. My contact information is below. Thank you.
And as always, give us a call, shoot us an email. We are here to help with any of your life insurance needs, and I look forward to talking to you soon. Thank you.